right. Thank you so much, Francisco. And thanks so much to all of you for being here. This is actually my first time in Miami. And one of the biggest things I've noticed about Miami is that it's a city that people like talking about. I came here from Washington, D.C. Washington, D.C. is not a city that people like talking about. And it is night and day coming to a place like this. One of the things people say about the Washington, D.C. economy is that it is recession-proof because basically everyone works for the government or something related to the government. And so whatever's going on in the broader economy, the government's always going to spend money, so it'll be fine. The flip side of that, though, is that the Washington, D.C. economy is also boom-proof. It's just stable. It's just kind of there. Politicians think that that's what people like. They think that people like just having perfect stability all the time, never having to think about risk or anything like that. And that's crazy, because then why is Miami winning? This is a city that's booming. It's a city that's building stuff. It's a city that's home to entrepreneurs. And it's a place that people want to go to. They want to go on vacation here. They want to live here. You see huge migration within the United States to here and from other countries to here. And so I think, I think that's just a very powerful testament to what's going right in America, what's going right in this state and in this city. And I think it's also just a great illustration from this beautiful venue that we're in with this amazing view, that this is what all of Latin America could look like with stable government and free markets. And it's never about the people. It's not the people's fault. This is, it's not anybody's fault that they were born in a country that doesn't have those things. It's not their fault that Javier Milei is the exception and not the rule. And it shows that if you have people, the exact same person picks up their family and moves here, it becomes much more productive. They are able to finally achieve their dreams and do what they want to do, and that is just a very inspiring thing. So, on to emerging market debt. I'm Dominic Pino. I'm the Thomas Rhodes Journalism Fellow at National Review Institute. Other panelists can introduce themselves.
Good afternoon. My name is James Fishback. I'm the Chief Investment Officer of Azoria Partners.
Hi, I'm Tom Powers. I'm a sovereign debt investor and portfolio manager at Dodge & Cox.
Hi, James Sagan, CEO and founder of Architect. Historically been one of the most active lenders in Latin America.
All right. I guess I want to start off with a little bit of history because I think that's important. We heard earlier this morning from Ricardo Mora, and one of the things he talked about was in the 1980s. Basically, every Latin American country was in default. This is something that Ben Bernanke actually talks about in his recent book, which is sort of a survey of monetary policy and the history of monetary policy in the United States. And one of the things he talks about, and whatever you think of him as Fed chairman, he is a very good writer and a very good economic historian, and certainly worth reading. He talks about how this was one of the unintended consequences of a lot of things that were going on in the United States financial sector and the Latin American exposure to that. From the Federal Reserve's perspective, they're not out there to secure financial stability for the entire world. They're just looking out for the United States. And one of the consequences of raising interest rates in the late 70s and early 80s was that it contributed to some of the instability and made things worse in Latin America. And so that debt crisis became a problem. Now we're seeing, again, the Fed is raising rates in response to inflation for the first time since that happened. But this time, things are a little bit different in Latin America. So I was wondering if we could talk about what the effects are of the Federal Reserve's new monetary policy, which has seen, up to a 5 percentage point increase in interest rates in a very short amount of time.
I guess I can take that first. So as a debt investor, we look a lot at interest rates across different countries, and we care a lot about the Fed, right? So I think the situation in LATAM today and emerging markets more generally is very different from those periods like the 1980s you mentioned, in which the Fed was hiking rates and there were a lot of sovereign defaults. A few reasons for that. One of them is that many of these countries have started issuing their debt in local currency, right? So if you have a huge stack of US dollar debt, the Fed raises rates and the dollar appreciates, suddenly you owe a lot more money. That's a big problem. That dynamic is much less in play than it used to be. Another factor is that many of these countries are raising interest rates themselves. It's a way of defending their currencies and their capital flows. So you mentioned how much the Fed has raised interest rates, but look at a country like Colombia, where interest rates have gone from, 5% up to 13%. Ricardo this morning spoke about Brazil and Mexico, who have had similar hikes in interest rates, and actually these LATAM currencies have been some of the best performing against the dollar in the last couple of years. So I think there's a bunch of factors that have made many of these emerging market economies more resilient over time. You could throw inflation targeting and other types of monetary policy in there, and changes to their institutional framework. So I think it's not exactly a comparable situation. The ultimate economic forces might be similar, but the risk, at least from an investor point of view, is going to be a lot less.
I tend to agree with you. I'd say that we primarily operate in the private credit space in Mexico and Colombia. I am concerned about the consumer and small businesses by virtue of the fact that you have pretty tepid inflation relative to the States, and yet a pretty sort of punitive interest rate environment. And so I guess the concern being that borrowing costs are much higher, and yet you have inflation has sort of lagged borrowing costs, which has made it difficult for businesses to pass on those costs to the consumer. And so I'm worried about, if our current macroeconomic overlay in LATAM persists. I am definitely concerned. On the other hand, credit penetration is so low. Household credit GDP is a fraction of what it is in the States, in Mexico and Colombia, which is where we primarily operate. And so, it's a tricky environment. But I'd say I'm not optimistic per se, except for the fact that credit penetration is very low. And so in our space, we feel pretty good. But in general, there's certainly legitimate cause for concern.
So Tom mentioned the other central banks out there that are pursuing their own monetary policy and the effects that has on the sovereign debt. We've seen inflation has been a problem all over the world, obviously. It's been a problem in the United States. But how have these other countries, with their own monetary policy, their own currency, how has their response to inflation been similar or different to the United States response?
Well, I'll say right off the bat, in 2020 and 2021, we all got hit with the same shock, right? The difference is that while EM central banks like Brazil were actively looking at the situation and tightening policy way before the US, what were US policymakers doing? We were undergoing a strategic review to introduce flexible average inflation targeting. We were talking about saving the world through monetary policy, tackling climate change and all of that sort. And so I think it speaks to the complacency in the US. Emerging markets have had a volatile couple of decades, and so they recognize inflation shocks when they happen. And to their credit, they figured out how to start tightening and to execute on that a lot sooner than we did.
Anybody else on that?
I can add a couple things. One is that I would totally agree with what James said. I was actually interviewing the governor of the South African Central Bank a couple of years ago, and he was almost taking a victory lap about the fact that they had outwitted the Fed and they had raised interest rates and prevented inflation from rising as much as it had in the developed markets. And I think there's something to that. The one point I would say maybe going against that is many of the developed markets, including the United States, had a massive fiscal stimulus that contributed to the inflation. And so in addition to the COVID shock that hit everybody, there was also this other thing that was maybe somewhat outside what central banks were doing. And so I think that ended up being a big factor that impacted both the US and some European economies.
Now, fiscal policy, of course, is controlled by elected politicians. We heard earlier today from David Bahnsen, who made the fascinating point that 40% of the world's GDP is electing a new leader this year. That includes the United States, but it includes lots of other countries as well. What do you guys see in emerging market debt for election and political risk?
I hate to be the bearish one up here the whole time, but I think that if you obviously in Mexico, the Morena party has, AMLO's just going to sort of pick a successor. That's very clear at this point. His rhetoric has been sort of, colossally scary, but he hasn't been able to achieve very much. And so there is a left wing, there's sort of a socialist momentum that tends to foment in these countries, and that's happening right now, with the exception, obviously, of Argentina. On the other hand, the Colombian peso depreciated sharply when Petro was elected and has subsequently recovered. And I think that sort of speaks to the fact that he's a lot less effective. Colombian institutions are much more robust than when this happened last time, previous to Alvaro Uribe. And so I think that I'm a little bit optimistic about the fact that these guys can't get anything done, but it's nonetheless really scary that there's this sort of socialist, leftist momentum fomenting right now.
I can add a couple thoughts. I want to go back to what Anthony was talking about so passionately at lunch about democracy, and also link that to what you were saying about Petro. So in many democratic countries, there's also a system of institutions, checks and balances, and things of that nature that make it so that it's very difficult for one person to change everything. Milei may be an example in the opposite direction, right? So he comes to power, he wants to do everything and change everything immediately, but there's many other forces that are preventing him from doing that, at least so far. So when I look at the impact of elections, what I'm really doing is trying to see what are the forces that could possibly prevent this person from doing something or not. So I mentioned South Africa example earlier. They're going to be having an election this year, and it's an election that is fairly critical because the party that's been in rule since the transition to democracy in the 1990s, the African National Congress, might be losing its majority. And so they may potentially be building coalitions with different other parties that could lead the country down very different paths. So in that case, I think it could make a big difference because they will have a majority in the parliament, and they're probably going to be able to pass the laws that they want to, even though there's still a strong judiciary, free speech, free press, and all of that will help possibly counteract anything that's too extreme. So I think looking at the institutions of the country and also what the median voter likes and thinks is very important.
One of the things that we also saw in the U.S. was banking instability that comes from this increase in interest rates. Financial institutions were not taking interest rate risk into account like they probably should have. Of course, Latin America has lots of exposure to U.S. financial markets and vice versa. So what impact, if any, do you see from financial instability in the U.S., possibly having ripple effects to other emerging markets in this continent and in other places around the world too?
So I just say that, again, to my previous point, credit penetration is so low in these countries. You have really fragmented capital markets as well. So capital markets infrastructure, I should say. And so like during COVID, for us at least, our Latin American book was far less volatile than our U.S. exposure. And again, we're less exposed to the general macro because we do a lot of niche private credit stuff. But I think that does speak to the fact that in spite of sort of the implied volatility of these countries and some of the consumer, your average consumer and these small businesses that just have such a small, negligible amount of debt relative to their developed market counterparts. And for that reason, I think it's a much healthier sector. I mean, there's just too many financial assets relative to real assets in the States. And so you can have less volatility and there's a lot more capital destruction. And that's not been the case in our observation. Places like Mexico, for instance, in the regulatory environment, because of the tequila crisis and other things like that in Mexico through Mexican history are much more the reserve requirements are much more robust, and so I feel pretty good about the financial sector in both of the countries that we operate.
Anybody else? Yeah.
Yeah, I can add something. So I think that's absolutely right. The countries that we're the most worried about are the ones where credit growth is really fast and prices are going up of capital assets like real estate and so on. So, for example, India is another country that I look at. They've had a couple waves of NPLs that they've had to work out in the last 10 years. It seems like they've kind of gotten through that process and dealt with the bad loans in the banking system. But it can also be developed markets. I mean, Sweden and Canada are countries where housing prices have risen substantially. And maybe, for example, the Swedish economy is slowing down because of high interest rates. These are things where there are potential financial fragilities. So I think in the countries where lending is more sober, let's call it, I think the risks are just lower. And I won't claim to be an expert on the banking sector in Latin America, but my impression is that you're not sustaining really, really high levels of debt where there's going to be some sort of a crisis imminent.
So we're coming off of a decade from, the Great Recession to 2020 of near zero interest rates, both in the U.S. and Europe. This was unprecedented. Jim Grant says it was the 4,000-year low point in interest rates. That's probably not going to come back. The chances of the being, we might see rate cuts in the later part of this year, but we're not going back to near zero, almost certainly. So how does that change the outlook for, well, first, what, if anything, did that do to the perception of emerging markets debt, and how did that weird low point affect that? And then two, since we're not going back to that, how should people be thinking about it differently going forward?
Well, I think the big thing to think about, we heard from Chair Powell this week, he talks about rates being obviously restrictive. Why are rates obviously restrictive? Because they were low for 10 years and now they're high? I mean, let's just be completely honest for a second. If 2 years ago we were talking in this room and I said, you know what, Fed funds right now is 0%. We're going to take Fed funds from 0 to 5.25%, and we're going to leave it there. Who would have guessed that we would have blown the water out of that jobs report this morning with 350,000? Who would have guessed that fourth quarter GDP would be tracking as high as it is, that we got 5% third quarter GDP, that retail sales this holiday season were impressive? And so this idea that we are in restrictive territory is wrong. Powell, when he came in, said very early on, he said, we know what the neutral interest rate is, which is to say the rate that is not stimulating the economy.
We don't.
Well, that's the end of my statement. Is we know the neutral rate, which is the rate that is not stimulating or restricting the economy. How do we know it? We know it by its works. We can't articulate it. We can't quantify it. But we know it by its works. And if its works are a stock market at record highs, if its works are 3.7% unemployment, if its works are GDP between 3 and 4%, strong retail sales, strong consumer. We heard this morning from Catherine what she say, that 2/3 of mortgage rates are actually below 4%. So all this hoopla in the fall about 8% mortgage rates, folks termed out their debt. It's a 30-year fixed rate mortgage, irrespective of what the Fed does. So I'm just not buying the argument that we're in restrictive territory right now. If this is what a 5.25% Fed funds economy looks like, sign me up. Let's get more of this. We're starting to see some really, really special growth.
Anything else on that, guys?
I would just say that if you look at the consumer lending sector, for instance, in Mexico, the effect on interest rate rises has been far less profound than in the States, just by virtue of the fact that rates are so high already, right? And so if you take in the States, let's say 10% of consumers are subprime, that's inverse in Mexico, right? And so, the average borrowing cost is so high that a modest increase of 5% is negligible with respect to their repayment capacity. And so we've seen, and I'm just taking consumer loans because that's where we've seen a lot of stress already, sort of like near-term delinquencies in ABS markets or shorter-term delinquencies have risen precipitously in the States at an accelerated pace. We haven't seen that at all in Latin America. And so I think the effect on interest rates in the real economy has just been far less impactful, generally speaking.
Yeah, I would agree with the comments from my esteemed colleagues. I think the question to me is, what do we think has changed in terms of the fundamentals that makes neutral, measurable or unmeasurable, change so much? There have been significant interest rate hikes in other economies, like the Eurozone economies, and it does seem like those have been effective at causing GDP to slow down and so on. So it's some of the factors like, for example, fixed rate mortgages in the United States. But there may be other factors like faster productivity growth that people didn't anticipate. And so one factor which I don't know if we've talked about much today, but I think is very important in my mind is the US fiscal situation. And we are borrowing much, much more in the treasury market than we were years ago. You can't double the supply of some asset and not expect its price to go down to some extent. You also are looking at, and I think a couple other speakers mentioned it earlier today, a future in which government deficits are 5% of GDP and growing, and it's not because of the sort of discretionary defense expenditures that we have, but it's because of Social Security, Medicare, and interest on the debt. So unless those things are under control, we're in a situation that isn't sustainable. So I think that factor plays into it as well.
Yeah, I just said to Tom's point, you're absolutely right. I mean, we can get 30-year fixed rate mortgages here in abundance. It's hard to get a 30-month fixed rate mortgage in the United Kingdom or the Eurozone. And so just think about it in terms of interest rate sensitivity. The average investment grade corporate duration has doubled over the past 20 years. And so overall, if a tree falls in the forest and no one's there to hear it, doesn't make a sound. If the Fed raises rates but no one feels it because they've turned out their debt and they're insensitive, did the Fed really raise interest rates? And that's at the heart of this conundrum. In many ways, this has been decades in the making, this lack of what we call the transmission mechanism of monetary policy passing through to the real economy.
Yeah, it's too bad the federal government didn't lock in the debt at 30-year rates, fixed rate back when interest rates were 1 or 2%. So obviously the 1,000-pound gorilla in the room of emerging markets is China. China has seen, complete opposite of the United States economic story coming out of the pandemic. They had, we think we had lockdowns. They had lockdowns. They don't have elections, but they do have intra-party politics that affects the decision making there. And of course, they have a authoritarian government that is cracking down on a lot of the things that were making China prosperous before. And so what do you guys see going forward with, we already heard about China on its own panel earlier, but I'm more interested in the impact that it would have on emerging market debt in general in Latin America, but also in India and in other places around the world. What are you guys, in your jobs, what are you guys looking at for how the differences in Chinese decision-making affect the debt that you are looking to invest in?
Well, let me just say that China was the parallel universe in which COVID went on forever. Okay? Anybody who says we needed more lockdowns, look at China. Anybody who says we need more government control of our industries, look at China. We need more regulation, look at China. I'm just not personally interested in investing in a country that is authoritarian, that is state-controlled, and is communist. And so whether there's an interest rate cut, whether there's more stimulus, at the end of the day, call a spade a spade. It is a dictatorial, state-controlled communist country. And so many of the mistakes that they made in COVID, thank the Lord we didn't make them here in Florida. We had a great governor. But so many of those mistakes have sown the seeds for the lack of growth and dynamism that is currently bedeviling China?
So I think there are a few exciting themes that'll come out of. I totally agree with you, James. So we find China to be uninvestable at our firm, and I also think that the animus that has been sparked over the few years is going to grow and fester over the coming decade or so. I think that really bodes well for manufacturing, not only in Mexico, which everyone's very excited about from a nearshoring perspective, but I even think some countries that have been a little bit xenophobic historically and are now opening up to the idea of bringing a lot of, like Colombia has an amazing latent labor force, for instance, that's underutilized. So we're doing a lot of supply chain financing, for instance, to sort of help lubricate this momentum, this growing momentum into Mexico. Both, auto has been historically, obviously, a very strong manufacturing sector in northern Mexico. And there are other more technical manufacturing capacities that are being built as well, which is somewhat novel and has not been the case historically. And so we're doing a lot of sort of private credit, supply chain financing, equipment leasing, and things of that nature, where there's just a real paucity of supply of capital and an unbelievably precipitous rise in demand for those products. So I think it bodes really well for the region. And also just from a political perspective, I think that it makes a lot more sense for the U.S. to acknowledge and embrace its neighbors in this sort of new world order, let's say, which I think bodes really well for corruption and criminality in these countries, where I think these countries will be more amenable to inviting the U.S.'s capabilities and help mitigating those sort of more corrosive parts of the economy, let's say.
My short answer to your question is commodities. I think China has been a huge importer of raw materials for the reasons that were discussed earlier today from Latin America, as well as some other countries like Australia. And that's led to strong trade ties, as well as significant appreciation of those currencies, Latin America or other commodity exporters, during the 2000s primarily. So in terms of how China's growth affects that, well, if it's slowing down and they're building less housing because the property bubble is imploding, that should have a decent influence on the world prices of those commodities and what these countries can export them at. There's also the nearshoring story, which has been explored earlier today, so I won't say much more about that. The final thing I wanted to mention is, on top of all the challenges that China is facing that we've talked about, the demographic situation isn't great. So even if they suddenly became a democracy with all the institutions that we love and so on, they would still have problems like that they would be facing. So they have a lot of smart people over there. I mean, they're very technically advanced, but they're also facing many challenges.
One of the replacements for China in a lot of people's thinking is India. India just passed China to be the world's most populous country. They are a country that has lots of challenges as well, but they are currently the world's fastest growing economy. By 2030, they will likely be the third largest economy total in the world. And so what do you guys see going forward for India? I know, Tom, you mentioned India earlier, but are you guys optimistic about India? Are you more cautious about it? And what do you see as being good investment opportunities in India?
Yeah, I think realistically, India is a little bit far from just being able to replace China, because there is a whole regulatory and institutional backdrop that needs to exist for manufacturing to just move over. Over, let's say, the last 10 years that I've been covering India, I've seen the Indian government talk about creating more manufacturing and bringing in more exports numerous times, and they've had various programs, none of which achieved the targets that they had set out. Now they're finally doing some kind of subsidies that are bringing in a few companies here, like Apple is starting to produce more iPhones, which is a big win for India. But they need to have more reforms around labor and land laws in order to really grease the groove for bringing in more manufacturing. So I would say don't hold your breath. It probably will be an unfolding story over the next decades, but it's not like this year suddenly we can move everything to India.
We don't really have the bandwidth to do much in India right now, just given the sort of technical, we have a very labor and administratively intensive business. And so, but if we did, I think India would be probably the most exciting private credit market in the world. And so I'm unbelievably optimistic on India, but we just don't have the bandwidth right now, so I don't do as much work as I should on it.
Sure. So just as we're running up on time here, I guess I'd like to hear from each of you what you think are some of the most promising emerging markets that you see going forward, and some of the ones that maybe people were more optimistic about that you are now less optimistic about. And obviously accepting China and India, because we already spoke about those directly. But which of those other countries do you think are going to be ones to watch going forward, and which do you think are ones to be more skeptical about? Well, I'll start here.
I think Mexico is going to be a really, really interesting partner for the U.S. I think that it benefits from the China story as well, that we want to diversify supply chains, reduce dependence, essentially on our enemies. Let's just call it, again, what it is. I also think that the immigration story, whether you're a Democrat or Republican, it's starting to come home to roost now. And so as that migration pattern starts to subside a bit, I think it can bring some stability to Mexico, because there's a lot of internal conflict there over that. So I would say Mexico for a number of different tailwind reasons.
I'm going to go out of the box and say I think some of the Central and Eastern European economies could be something to watch. I think, they have historical and institutional backdrops that might allow them to succeed. They have a history of communist domination that maybe set them back quite a bit, but in certain places they've been doing very well. Poland would be an example, which has had one of the highest growth rates in Europe over the last 20 years and is wealthier on a per capita basis than some Western European countries now. So yes, there's a lot of noise around populism, or maybe their government is at odds with the EU or something like this. But at the end of the day, it's really, do they have the technology, education, workforce to be able to produce effectively? And it looks like they are growing in that way.
I'm obviously biased. I've been very focused on Mexico and have developed sort of a theme around it for the last 8 years or so. So I do think Mexico, I think there's a lot of really fortuitous macroeconomic overlays that make it even more promising and interesting than I sort of had suspected. But where am I most concerned? I'd say that I'm pretty concerned about Southeast Asia. Just the reason being that there's sort of this sort of complicated changing world order, and I think they're going to fall on the wrong side of that, and might fall under the auspice of a more authoritarian regime, being China, and that'll sort of be complicated for free trade reasons. So.
Well, thank you so much, everybody. This was a great conversation, and look forward to the rest of the day.